and welcome to The Full Perspective. I'm Charlie Thomas, the Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into the week's most significant stories. This week I'm joined by Insurance Insider's Editor-in-Chief Adam Menestri.
Hey Charlie.
Hi, and Insider's Managing Editor Catherine Shee.
Hi.
Thanks for being with us, guys. So we're going to start in Bermuda this week with the news that Sirius is in advanced merger talks with total return player Third Point Re. Sources have even indicated to our team that these talks are now exclusive, with earlier interest from Apollo and an unknown private equity house being stood down. Adam, what's your take on the next steps here? Is there any chance that the talks could fall down at this stage?
Yeah, look, I think typically when you've got exclusivity in a deal, you have a price agreed and you've probably got a relatively smooth run through to signing. I think there's a lower likelihood with this combination that the deal will get over the line. And essentially, you have an unusual situation here with Sirius, where there is an independent board and it's a listed company. It's NASDAQ listed, but 96% of the company is owned by CMIG. And there have been significant disagreements between the Sirius board and CMIG in the past. So you have, let's call it, complex stakeholder relations between the two. I mean, specifically, we saw a situation where CMIG is distressed. It's defaulted on some of its debt, and it's been very important for Sirius to kind of ring fence itself and put in place governance to show that it has autonomy. And it was trying to sort of solve the problem of being 96% owned by CMIG by doing a rights issue. That was blocked by CMIG, and this kind of like burst forth into the public as this really acrimonious fight between the company and its key shareholder. So in the past, you've had sort of examples of real clashes there that have been a big problem for the business, and I think there's definitely scope for it to be kind of a winding road on the way towards signing, because you could have a situation where the Sirius board wants one outcome and CMIG wants a different outcome. That'll be a really challenging outcome for Sirius, because you could have a situation where a deal with Third Point, a merger deal, was recommended, CMIG votes the deal down, and then you get a ratings agency downgrade. If you get that, that would definitely bring other private equity back into the picture, including quite possibly Apollo, which was partnered with its legacy platform, Catalina. So I don't think there's necessarily a simple path towards signing in the way you might expect. And it's possible the story has a long way still to run.
Mm-hmm. Let's assume that the talks are progressed to the point where the deal goes through. What would it mean for both parties?
I think it's an interesting one here. I think it leaves a lot of questions unanswered if you look at this transaction. So both sides are trying to address challenges through a transaction. On the Sirius side, primarily you have an ownership and a ratings agency problem. They need to try and dilute down CMIG, and they need to do that because it will demonstrate the independence of the business, or guarantee the independence of the business, which will protect the ratings. Currently, their A- rating from AM Best is imperiled. Now, given the relative valuations of the two businesses, which are pretty close, in fact, Sirius has a slightly larger market cap than Third Point Re, it's difficult to see how a transaction that is likely to be almost entirely paper, if not entirely paper, would deal with the ownership problem that Sirius needs to deal with. Maybe you could get CMIG below 50%, but even then there would be sort of implied control, arguably. So I think it's difficult to see exactly how this solves problems for Sirius. I think for Third Point Re, again, there's a ratings agency issue that it needs to address. It's sort of it's sort of got the range of challenges faced by most of the cohort of total return reinsurers. The ratings agencies have turned on, so AM Best has turned on the model, or become much more hawkish on the model. At the same time, the underwriting and investment, well, primarily underwriting results, but to a degree, the investment results have been weak or have shown volatility, not in favor with investors, trading at a big discount. And there's always the danger that they're going to fall foul of the PFIC rules. So there's a lot of challenges there, and they're going through a process that's similar to some of their peers in trying to transform themselves into a more traditional model and become a specialty reinsurer and insurer. Sirius, in a sense, does something for them there, and it makes it a much bigger underwriting business, and in that it dilutes down the proportion of assets that are invested by the hedge fund. Arguably, it's not going to get them to a point of showing underwriting profit, which is what they long-term underwriting profit, which is what they really need to do, because there's some remediation work to be done with Sirius as well. So I can kind of see the transaction making sense from a third point perspective, but it's not necessarily a silver bullet for them.
Yeah, I guess I was about to say, Charlie, that this is surely Third Point Re trying to find an answer for the total return challenge, or the challenge that exists around this cohort of total return reinsurers. And if you look at other companies in that cohort, you've got Watford, who has got 3 activist investors now, saying that value has not been created through the model. And you also have Greenlight, who tried to monetize itself through a transaction, and essentially that transaction didn't get done. So I suppose it kind of raises the whole question around whether there is something inherently flawed about the whole total return model, and perhaps it did work before, but does it work in this current operating environment?
I think the model has fallen out of favor. That's definitely the case. But I want to push back a little bit on the idea that it doesn't work to have an aggressive asset management strategy within insurance, that you can't use insurance as a means of generating float to invest. I mean, if you want a counterexample for that, how about the original total return player? How about Berkshire Hathaway? There you have very talented underwriters producing strong underwriting results, generating huge float, which is then invested by a legendary investor in Warren Buffett. And Buffett also provides a kind of regulatory shield for that business as well. It can be done if you have the right asset manager, and if you have good underwriters and good competitive positioning. But it's hard to get all of those pieces in place.
We're going to return to EC3 next with news that specialty rates in London are continuing to accelerate. Katrin, why don't you talk us through the key points here?
Sure. So we published an article this week, which was based on a very broad canvas of London market executives, so from both the underwriting and the broking side. And canvassing on the underwriting side in particular, we came up with a range of a risk-adjusted rate increase of around 10 to 15% as of the end of May. So obviously this is very, very kind of broad canvas. It completely depends on how your portfolio is made up and which areas are performing better than others. But the majority of people fell within this range. There were a couple of outliers that kind of really went for kind of 20% risk adjusted rate increase, and they were weighted more towards the better performing lines in terms of rate. Now, the interesting point about this is actually we did a similar sort of canvas in January, and obviously that was before we knew we were about to have a global pandemic and its impact on the market. Back in January, the same canvas was looking at sort of mid-single digit to 10% rate increase, a couple of outliers on the 15% rate rise. So that is actually a marked acceleration of rates in London for specialty. Now, part of that is actually because the treaty market is now picked up since January. We've had distinct rate increases in Florida and also Japanese wind renewals in April. But actually, people speaking to us have said that they feel that this is actually driven out of fear rather than pain. And that fear is actually the sort of growing realization, or the kind of being resigned to the fact, really, that this is going to be the 4th year in a row where London as a market will not have made an underwriting profit. So really it's around the fear of not making money. We haven't actually seen the pain being taken from any COVID-19 claims or anything like that. And also the underlying drivers of what we were driving rate momentum in January are still there, right? So you've still got a potential reserving issue, and there has been some social deflation as a result of the COVID-19 crisis. But sources think that this is only a momentary thing, and we still have the broader trend of social inflation, particularly in the US, for liability lines. Now, obviously, as I said, there are pockets of better rate increase than others. These will include open market property, so your direct and facultative business, where you're seeing 20, 25% rate increase. D&O, you can get anything from 20 to 50%. Some of the excess layers are registering sort of triple digit percentage increases. Cargo is another good pocket. There are also some stubborn pockets. So you've got accident and health, which doesn't seem to be moving very quickly. Terrorism and political violence is another example. They're proving to be more stubborn and kind of dragging that overall blended increase down if you write that business. But what is important is that there does generally seem to be improvement across the board. And what is really important actually is that the mid-year renewals this year was kind of the real first test about whether London would be able to book rate on rate increases, and whether insureds would be willing to pay more again for the second year in a row, and that appears to be happening. So that is a great sign for underlying profitability, though we know that obviously there's a big challenge to come around COVID-19 and the claims associated with that.
Yeah, definitely. And I suppose, COVID-19 aside, that the billion-dollar question is how much can London capitalise and convert on that opportunity that's been put in front of them?
Sure. I mean, and also, recently we've had lots of individual companies coming out with announcements that they're raising money in order to capitalise on this. I mean, if you just look at the listed players, for example, Hiscox, Beazley and Lancashire, through their equity raises, they've raised almost £900 million worth of capital just between the three of them. But obviously there are other headlines, which I'm sure we talked about before, around startups and PE interest, but there are also other ways that companies can raise capital in order to capitalise on this. So they could raise more debt, preference shares is another option. And one which actually hit the headlines this week was the idea of using the legacy market to free up capital. So we reported the news that Canopius is considering a potentially very significant legacy transaction on as much as £1 billion worth of reserves in order to free up capital and then redeploy into an improving market. Now, this is important because, and I'm sure the legacy market is very pleased to hear of this sort of news, because this just shows another step in moving away from the previous perception that legacy and runoff was only for toxic bad business, when actually you can use it as a capital optimization tool.
I think the other thing to think about here, Catherine, is the role of Lloyd's. A crucial question now for the London market is how Lloyd's, the corporation of Lloyd's, is going to react to and oversee the market as we move through this period of hardening. I think it's fair to say that there is a feeling that Lloyd's in the past has allowed the pitch to go past when it comes to new capital formation, following on from 9/11, following on from KRW. And I think it's going to be really interesting to see whether or not Lloyd's really goes out of its way to encourage new capital formation and to say, well, we need a piece of that. Martin Reith, despite slight checkered history at Lloyd's, you must come and have some of your startup at Lloyd's. Richard Watson, kind of Lloyd's stalwart, you must have some of your business there. Dinos, you should have a platform in London. Ed Noonan, Jeff Consolino, you guys should be expanding into London as well. So I think that's something that we'll be looking out for, and which Lloyd's really should be looking to do. And the other question is what happens to existing players within the marketplace. I think you're seeing some really ambitious growth plans. We've written about ARC looking at a 750 million to $1 billion raise and talking, floating the idea that it could be 2 or 3 times its size within 2 or 3 years. And the question is Lloyd's going to allow good businesses like that want to build a franchise during a hardening market or really accelerate their growth? Are they going to let them do that, or are they going to hold them to a sort of? Are they going to constrain what they're doing? And then how does that differ when you're looking at a good business like an ARC or an Atrium, a MAP, an Aegis? How will you treat those guys? And then how will you treat players who've been second quartile players or third quartile players or fourth quartile players? And I think that's a huge outstanding question for London right now.
Food for thought for John Neal there. Well, I'm afraid that's all we've got time for today. My thanks to Adam and Catherine for joining me.
Thanks, Charlie.
Thanks, Charlie.
And thank you guys at home for watching. Until next time, stay well, keep safe, and we hope you'll join us again for another episode of The Full Perspective.